This fund manager has beaten his benchmark by more than 4% a year for 20 years, and today we're going to unpack how. From Equity Mates Media, this is Basis Points, a show that helps advisors find small improvements that compound into big outcomes. I'm Bryce, and with my co-host Ren, today we're speaking to Ben Griffiths, the Managing Director and Senior Portfolio Manager at Eley Griffiths Group, who has over 30 years of experience in the financial markets. Ren, good to be with you.
Bryce, good to be with you. Excited for this one. Ben Griffiths is a legend of Australian funds management. He's particularly known in the small cap world, small and mid cap world. And as you said in that introduction, more than 4% a year outperformance over 20 years. Like, that's an incredibly long track record.
Yeah.
And so today we wanted to unpack his toolkit, the methods and philosophy and knowledge he's built up over that time in markets that's helped him outperform, that's helped him build a team that's able to continue to outperform. And so we're gonna go pretty deep. We're gonna go on how he consumes news and media, literally what he does when he wakes up in the morning and what he does before he goes to bed at night. The metrics and ratios he's looking at when he starts to analyze companies, the non-negotiables and the things he's looking at. He revives a few out of favor metrics, I would say.
Yes.
Yeah.
Yes.
Books. Talks about the books he's reading, how he wants to be a constant learner, and he gives us 4 books to read. Luckily, we had read at least one of them.
Yes. Yes, only one.
And then we get into the market today.
Yeah.
We talk about a sector that he thinks investors should avoid at the moment, and also one that he's particularly excited about. He gave us a stock that he thinks is the most exciting in that sector, and I wrote down a quote, a pretty bullish cocktail for stocks.
Yeah. This was a great interview. I think we were furiously taking notes throughout. There's plenty of actionable insights in here. I think his experience really shone through. Really enjoyed this. So before we jump into it, Ren, a huge thank you goes to our partners here at Basis Points, SIBO, Milford and Orbis Investment. Without our partners, we won't be able to keep the content here free and accessible for everyone listening today. So a huge thank you goes to them.
And a final note before we get into it, every episode of Basis Points, including this episode, is accredited by the FAAA for CPD points. So if you're an advisor looking to claim those points, head to the podcast show notes or the YouTube description. There's a link there. Fill out the quiz. We'll email you your certificate and claim the credit for the work you've done. Not that listening to this is work.
Well, with that said, let's get into our interview with Ben Griffiths. Ben, welcome to Basis Points.
Great to be back, Bryce.
So you've been in markets for decades. You've seen it all. How would you say your approach has changed over time? And are there any sort of tools or techniques that have really stood the test of time in your investing textbook?
Yeah, look, I think obviously I've earned and developed a great experience bank, which is critical. The market does repeat. It takes a different form, but it does repeat. So it's great to be able to stare down a crisis and say, I know what we need to be doing here. So, but certainly over time, I'm better read. I've learnt along the way that I need to be continually reading, whether that's the Wall Street Journal or the Financial Times of a daily basis, or whether it's a book by one of Wall Street's masters. You need to be continually reading. And of course, in recent years, the advent of podcasts, of which you guys are well familiar with, that's another critical part of the puzzle. And there is some unbelievable high quality product being produced, in addition to Equity Mates, of course, but there's some great international product being produced. So I think the learning has continued, and the learning is absolutely critical. And I can't imagine being in the markets and not being tapped into daily news flow and tapped into reading about some of the masters and how they invest. We've all got plenty to learn, and I'm not even halfway done. I'm convinced of it.
Love that. I think it's a theme we see over and over again with the best investors we speak to. It's that constant learner mentality, that curiosity to always want to just keep learning. And I think today we want to kind of unpack some of the tools in your investor toolkit, some of the knowledge that you've picked up over the past 30 years. Let's start at a market level. When you're trying to read the mood of the market, what are some of the indicators that you're looking at most? How much do you pay attention to, like technicals, sentiment, macro data, the like?
Well, they're probably three really critical areas
Okay.
to focus on. To be completely serious, I never leave home without my chart pack. So I'm forever checking the temperature of a market by its technical health.
Okay.
And I'm talking there about long-term charts. I want to look at long-term support lines, long-term resistance lines, and on stocks and indices and commodities.
What's long term?
Well, long term for me is 5 years plus.
Okay.
And frequently, in the case of when the markets were melting down during COVID, I remember sitting back looking, saying, where is the method to this madness? Because markets were really, really selling off. And I pulled out a long-term chart of the ASX 200 and a long-term chart of the small ordinaries. And lo and behold, the market had pulled up on long-term support that had been in place since 1993. And every major meltdown, and with that I'm referring largely to the meltdowns of back in 92, 93, the dot-com meltdown in 2000 and the GFC in 07, 08 into 09, every major meltdown had pulled up on this big, fat, well-defined support line cutting across those two indices. It was almost like for me, it was an epiphany. I saw it and thought, markets aren't going any lower. Markets have pulled up on support. Time to buy.
Wow.
Not time to go to cash yet. If you read the popular press, you're being told to cash up. COVID's hit. It's going to be bad. Technicals certainly looked after you. Look, I look at a whole bunch of oscillators and indicators as well as long-term charts. I look at the COPOC indicator. I look at the Williams percentage R oscillator. I like to have these in the background. I look at those. I also look at sentiment. I need to measure sentiment, and I want to know about professional positioning. Are the big professional traders in the Australian share market getting short the major stocks? I need to know whether, if I'm getting excited and getting long and they're getting short, am I wrong somewhere here?
And how are you getting that information on what the big institutions are shorting?
Yeah, well, I'm in the very privileged position, Alec, where I can access Bloomberg data and I can see how short interest looks. I haven't gone onto the ASX website to see whether they publish short data, but it's quite critical to know how the positioning is. So I rely on positioning data to know whether I'm swimming against the stream or in fact I'm on trend. I need to know about, and I talk to a number of private client stockbrokers, and so would many of your listeners. And they're a great barometer as well, and they can tell you whether their clients aren't doing much, or they're not backing IPOs yet, or they're all sitting in cash. I like to listen to that to tell me whether, in fact, again, am I swimming against the stream? I look at credit spreads, and that's the difference between long-term money, 10-year money, and 2-year money. And some of the US published credit spreads, such as the BAA less 10-year bond spread, that tells me about risk and riskiness. And right now, credit spreads are quite narrow and tight. There's not a lot of angst. Confidence is high.
Which is funny, and we're going to talk about that in a second. But I think for people listening, just pin that the idea that confidence is high at the moment.
Yeah. No, we can certainly come back to that. And I look at a sentiment indicator that you can get on the website. You can jump online and get it, which is the AAI survey published every week in the United States, and that's freely available. And that tells you whether large institutional investors are bullish, excited, or bearish and anxious. And then finally, macro data. Well, we're all absorbing macro data, and that gives us a bit of a feel for contemporaneously what's happening out there. So I use all of these tools, and I never forget to look at them. They're always front of mind when I'm approaching a day as a trader.
These are things that you're checking daily. Maybe not everything you've just listed, but this is a daily process for you to check in the pulse of the market.
Certainly is, absolutely. And in fact, better than just checking in, it's also notating. It's keeping it like a diary, keeping a book and just noting down your observations.
Wow.
And just,
geez, I'd love to get my hands on. Like you have a physical book that you're writing in.
Yes,
I'd love to read it. Yeah.
It's just documented so that you're forever referencing back to things and notes and comments. You need to be methodical.
Yeah.
Are you doing this at the start of the day or just throughout the day? What's the
start of the day? Because so much of it is international data.
Yeah.
So I get it down, and I regularly present the findings on a weekly basis to our team. We share what I'm observing and what we're seeing out there.
Have your team followed you, and do they all have their books that they're notating in as well?
They've all got their own books. I'm not exactly sure what goes in those books, but they have got books. They certainly also keep diligent notes.
Yeah.
But I pride myself in making sure that some of these macro indicators and these technical indicators are being observed and are being discussed. So that's my job.
Nice.
As head of our business, I need to be across that stuff.
So how do you then filter through all of the noise and of everything that you've just spoken about there, really drill down on what's actually meaningful and going to drive markets? Like, are there any in from what you've just said that you lean on more than others?
Yeah, I mean that's a good question. It's Howard Marks, who many of the listeners will be aware of, who's a legendary market commentator and fund manager, said that there's little logic in investor psychology. And one thing for sure is when you're looking at sentiment surveys, it's all about investor psychology, and you do see situations of things that just make no sense at all. The AAII, which I referenced before, the American Association of Institutional Investors, that survey that's published weekly, the value of that is you look at it every week, and it'll say whether people are very bullish or very bearish. Where it's really valuable is when it's at extreme settings, when the world is despairing, when it's extreme pessimism. That's normally telling you there's a buy setup coming, and equally when it's extreme optimism, it tells you a bit of caution is warranted. Right now, of course, it's mid-range. So now we've come back from those extreme pessimistic levels. We're now about mid-range, so we're not overextended. We're okay. I mentioned credit spreads, and that just tells you straight away what is the health of the credit and borrowing markets in the United States, for instance, where they're actively published. Looking at those will tell you whether there's angst at corporate level or whether there's a degree of comfort. And right now there's a strong degree of comfort that corporate America is in good shape.
And we put a pin in that earlier, but I think it's worth just dwelling on that for a second. Like, how do you explain, on one hand, the noise that we're hearing about, rising government debt levels in America, but also questions around how corporations are going to deal with changing policies on tariffs and the like, and then the fact that credit spreads are so narrow at the moment.
Yeah, that's part of the art of being a good investor and a consistent investor. We're all humans and we all react to front page headlines, right, and scaremongering and so on. But I've learnt along the journey is look at the data. Right, it's not so much the news; it's the effect the news has that really matters to investors. So look at the data. You'll hear that American corporates are doing it tough, and they're not in crisis, but they're doing it tough, and things are. But you have a look at credit spreads, and that tells me that professional investors who are placing bets, who are underwriting bond issuance and so on, they're very calm. They're not demanding big premiums for them to invest. They're putting up with quite mild, and they're paying very, very mild and modest premiums. So what I've done basically, Alec, is try and listen to the noise, but actually react to the data.
Yeah, I like that.
That's the trick. The trick is seeing what the market's telling you. The market's telling you that everything in a corporate sense of the US is fine right now. And the final thing I do look at is what they call the equity risk premium. That's a big concept. It's a concept that you don't see too much. It doesn't tend to get a lot of airtime these days, and that's essentially it's known as the ERP. And the equity risk premium is essentially how stocks are priced versus bonds, and is there a sufficient buffer for investors to place an equity risk versus a bond market risk? And I look at the ERP, the equity risk premium, as well.
So for people that are familiar with Eley Griffiths, they might be familiar with the funds that you offer. 3 funds that all invest in Australian and New Zealand stocks. So people might be wondering why you're so focused on so many of these US indicators. What is the reasoning there?
Yeah, that's a fair comment, and we do get asked that from time to time. It's just important for us to have a macro setting set in place, because the macro then drives how we think about company earnings, how we think about how revenues can grow, how we think about the ability of a company to cut cost and optimise its operations. And you cannot have that discussion without you need to start somewhere, and invariably the pulse and the tempo of markets is struck in the United States. The bond market direction will start there, the rest of the world will follow. So it's a really, really instructive place to start, is to get your thinking around what the US trends are suggesting, and then you superimpose it on what's happening in the Australian market, because if rates are going down in the US, they're going to be coming down here too. And so it's critical to start somewhere, and that is the best place to start.
Yeah.
If for no other reason, it's where the capital flow is. It's where the big bets are placed. And we are simply not an island. We are captive to what happens there. So we absolutely spend time on getting the macro right, because it has such a strong influence on our underlying company assessments and how we build out our models.
Well, speaking of, let's move to sort of the fundamental side. What are some of the financial metrics that you guys have as just like non-negotiable when it comes to starting to screen companies?
Well, the first and foremost one, the obvious one, I suppose, is the matter of solvency and balance sheet health. We're looking at an investment proposition. Is this business in fact solvent? Can it pay its bills? Does it owe money? And so the balance sheet health or financial leverage is how it's often referenced. What is the state of the business's financial leverage? And there's a bunch of metrics that can measure financial leverage. But essentially, we can't move from square one. We won't take a meeting. We won't open up a spreadsheet and start modelling the business unless we're convinced that solvency is spot on. And the second thing, of course, once satisfied that the business is vital and paying its bills and operating as a functioning business, the next thing we look at, of course, is valuation. We like the look of the business. It seems to be solvent, but look at the valuation that's been attached to it. And valuations, I'm talking about whether it's simple PE ratios. The PE is far too high for the level of earnings growth the company's going to demonstrate. Is the PE high versus the history of that business? It used to trade on a 9 times multiple. It's now 30 times. Am I sure I should be even buying this? How does it look versus the market? Is it on a 35 times multiple in the Australian share market's on 17? And also how it compares to its peers. So valuation in its simplest form is expressed as a PE, and that's what we use. And PE is a very important to the first plank of getting a valuation discussion right. And then there's other variations on that, which many of your listeners will have heard of, PEG ratios, which is a play on PE ratio versus earnings growth.
Yeah.
But PE, valuations, and company solvency are simply, I think you used the term not negotiable. I mean, they are not negotiable when an investor is sizing up a proposition.
Yeah, nice.
Well, let's drill down on each of those, because I think they're really interesting points to go deeper on. So starting with solvency and balance sheet strength, what are some of those metrics you're using to assess resilience? You said there was a long list there, so maybe just some of the key ones that you think about. And then how do you sort of contextualize that in what's happening with the macro that you spoke about earlier? You know, we rates are starting to get cut now, but you know they were higher than they were a couple of years ago. So yeah, how are you assessing the resilience, I guess?
Yeah, resilience is a great term, because resilience speaks to a company's ability to get through the cycle. In good times, it's a bit of a given that your resilience looks after you. It's in the tough times, resilience comes to play. I want to share a quote with you guys and the listeners, and it's a Warren Buffett quote, and I hear everyone say everybody's got a Warren Buffett quote, but I've got a quote that not many will have heard before, and I think it really, Alec, hits the head on resilience as you talked to before, and it goes something along the lines of long-term strength of a business is closely related to its ability to raise prices without much agony. You can learn a lot about the durability of the economics of a business by observing its pricing habits. And that's so critical, that companies can move volume through their business, but are they afraid? And many companies are just a little bit anxious about how do we raise prices. We're going to see this on display in the United States with the tariffs that we're learning about now that are coming to bear. Will companies absorb the tariff impost into their margins, or are they simply going to put their prices up by the extent of the tariff? This is going to be a real test for companies, company resilience, as to how prepared they are as just to whack a big tariff on and see whether the customers take to it. So resilience is a critical thing. One of the great measures of a company's resilience is its return on equity, which is another ratio, a very popular ratio, but that tells you how capital is being employed and whether there's an ample return being earned on that capital. With return on equity, we look at it in terms of what is that number? What's the magical return on equity number a company should have to illustrate its resilience to get through the cycle? There is no magical number.
I was going to
by the
ask,
way,
is there? Yeah.
but the magical number looks something like a number that covers the business's cost of capital. Whatever the company's cost of capital, that is the cost of being able to fund operations, your returns must exceed the cost of capital. And in many times, you'd be surprised, listed companies, they barely meet their cost of capital. So we look straight away, resilience comes from earning returns in excess of your cost of capital. And the other important dynamic, and doing the deep dive as you suggested, Alec, was incremental ROE, and that is for every extra dollar of capital you employ, are you getting an extra return on your capital? In other words, are profits increasing enough to justify the extra capital it's gone to earn? And that is the whole essence of market, is the marginal approach or the incremental approach. An incremental ROE is one of those secret weapons that analysts do calculate, and you want to make sure you're seeing an improving trend, that you are getting bang for buck on extra dollar of capital. Are you seeing that resilience come through? And the final measure I like to look at is free cash flow yield in a business. That'll tell you about resilience. Once a company has earned its cash, is investing in its capital expenditures to keep the lights on and keep the business moving, is there any cash actually left over after your investment? And that's called free cash flow. And free cash flow is the panacea. That's the cash that the market salivates over, because, for simple reason, resilient business that has surplus free cash flow means it's going to be paying dividends. And dividends come back to shareholders, and that comes to the very heart of resilience. So we need to look at ROE, return on equity, and we need to be across free cash flow yield as an important indicator that, look at this is a resilient, sustaining business.
You mentioned the PEG ratio, a ratio that doesn't get as much airtime as PE. Why is that important lens for you?
Well, it's a discipline. It's a very basic structure. It's a structure that anybody can calculate. And what it does is investors have to work out, they have to get away from following the mob. And following the mob means you're going to be following fads and fashions, people getting stock tips on Reddit or Robinhood, or going to stock twits, or heaven forbid, perhaps even equity mates. But investors need to get away from fad investing and fashion investing and investing with the hot crew. They need to have their disciplines. PEG is a very simple price versus earnings per share growth discussion. I like it because it's stood the test of time. It's been around for years. You're right, it feels like it's a bit out of fashion. No one really talks about it. But let me tell you, Peter Lynch, who famously ran the Fidelity Magellan Fund and regarded as one of the world's great equity investors of our time, I say my time, I'm a little older than you guys, but I'll say of our time, and Warren Buffett, of course, each of those investors used PEGs. They thought that they regarded PEG investing, price for earnings growth, as being a critical discipline for investors to have. And all it's really saying is, there's your PE ratio. Am I paying too much for the fact that this company will grow its earnings by 5% next year and 5% the year after? Am I paying too much?
Yeah.
Or I can put up with a very low growth business. I just mustn't pay too much for it. That's the essence of PEG.
It differentiates two companies that are both on a 20 times earnings multiple, one that's growing at 20% a year and one that's growing at 2% a year.
That's it.
Yeah.
That is the essence. Now, if you're just following the fast crew, you're not actually thinking about that. You're just buying it because it's going up. You're using momentum as your discipline, and you need to be better than that. Investors who want to be around, who want to get through the next cycle, they need to be better than that.
So do you have a magic number for PEG? Like, sometimes we read that a PEG of 1 is fair value, but often you know that as PE multiples expand just generally across the market, you find less and less companies that are a 1 or lower.
Yeah.
Do you guys have a magic number?
There's no magic number, but as you say, the lower the number, the better.
Yeah.
And once again, if you're not sure what the number should look like, and you're looking at a retailer, then you might do a PEG ratio on Nick Scali. You might do it on Beacon Lighting. You might do it on Woolworths and Metcash, and just to see, I see what the PEG should look like. It should be a number that's, if I'm in the industry norm, I'll be 2 times, and heck, I've found a retailer here that's 0.8. Well, that's cheap. So there's no magical number,
Yep.
but if you look at them long enough, you'll know where it should be, and you're right, Alec. It's a sort of number that should be ideally sort of at the lower end of the spectrum. But just have a quick look at the competitors in the space and see where they're trading. And you might expect the ones that have superior management with superior prospects will have a slightly more fuller peg because people are paying a higher PE for it.
Yeah.
So pretty critical. I mean, I think the peg is a great default for beginner investors to have in their back pocket. It's an easy one to calculate, and we can all get fancy and sophisticated as we develop and go further down their investing careers. But PEG's a great place to start. It's where I started, and you know, I'm still there. I'm still looking at PEGs.
Yeah. And you've done pretty well in the meantime. So one other, I guess, factor that you've called out previously when you're looking at a business is operating efficiency. So can you just define that term, like what that means, and then what are the signals that you're looking for that a business is being well run?
Yeah, well, operating efficiency clearly is, in the first instance, is being able to survive through tough economies, tough markets, and good. So getting through the cycle, because there's always a cycle, right? And as to where you are in the business cycles, that's important. Operating efficiency for me, as I sort of touched on earlier, is your ability to earn returns on your employed capital that is better than your cost of capital, and consistently so. I talked about operating cash flows. I mean, that's another classic indicator of operating efficiency. There's a number of ratios, sales to total assets, sales or revenue per employee, where you can see, I mean, how efficient your payroll is. Have you got too many heads not generating enough revenue? So there's various ratios you can apply, and anybody can access those from an annual report. You can get revenue lines and you can get employee numbers. So you can do those calculations yourselves. And the other one that I like about efficiency of a business is their propensity and their consistency of dividend payment. It's a very, very good signal. It's a good discipline for boards to be in, to pay dividends. It's a great signal when a company hasn't skipped a dividend in 25 years. It means it understands the central argument of we run the business professionally and proficiently, and we give the owners their ample reward. So operating efficiency picks up on a couple of themes, but it is about sustainability, and it's about and it's about returns on capital primarily.
Ben, we've just covered off all of the elements that go into your investor toolkit, and there were some great takeaways there. I want to bring it up a level and talk about your philosophy and process a little bit more. And no doubt, I mean, towards the start of this interview as well, you mentioned how reading is such an important part of your process, ensuring that you're dialed into what's going on in markets on a daily basis. So how has reading shaped your investment philosophy, but also are there any books or, I guess, like, as you said, Wall Street wizards that you would recommend us reading?
There have been some books along the way, and I've got over 30 years, almost 40 years of collecting books and buying books. And I've got to say, I had a look the other day across my bookcase at home, and there are some extraordinary works up there and pieces. And I sort of thought about what are the four that if the ship goes down, I've got to get these books out of there and get them in my kit bag, and so I thought I would bring a couple along and share them. And I'll tell you the four books that are certainly available through Amazon and the like. The first one is from an author who is so highly regarded. He passed away in 2013, but was so highly regarded at the time this book was published by Wall Street's elite fund managers and traders, and that's Martin Zweig. And his book is called Winning on Wall Street by Martin Zweig, and he details how he approaches the business of investing. Some of the listeners will know of Jason Zweig, who writes for the Wall Street Journal. I did check they're not related, despite the potential connection.
Oh, right. Okay,
so they're not related, but Martin Zweig was as big a legend as you'll find, and passed away a number of years ago. So Winning on Wall Street, a must read. One by an Australian author. We don't get a lot of. There's a few books that have been written here, but not many of an impact or a caliber that I would rush into endorse. Taming the Lion was a book I think it was first published in the mid 2000s and issued by Richard Farley. And Richard Farley now is I think he's semi-retired, lives in London now. His book on how he approaches the business of trading assets, trading stocks, and his rules are outstanding, and I regularly reflect back on them. I've quoted his rules of trading in quarterly reports that I've sent to our investors. He is as potent and as considered an investor as I've encountered. Fantastic, and he's an Aussie living in London. So Richard Farley's Taming the Lion, one with a really cringy title. Before everybody sort of cringes and maybe turns off, You Can Be a Stock Market Genius by Joel Greenblatt. You Can Be a Stock Market Genius by Joel Greenblatt is a very simple, straightforward book. It's outstanding. His observations, again, as a seasoned Wall Street fund manager, in that book are terrific. He's had subsequent books. None of them are as good as this one. This is the first. This is the best.
Yeah.
And the final one, I talked about Peter Lynch before. And I remember my late father, bought me this book for Christmas at the beginning of my investment career, and I didn't read it straight away. But I read it a number of years later, and I've since read it several times, and that's One Up on Wall Street by Peter Lynch. And that is a great primer for anyone looking to start the business of building a share portfolio and getting investing. One Up on Wall Street, there's a reason why it's a bestseller, and it's a bestseller every year because it's so readable and it's so real and accurate. So they're four books that have really informed on my reading. There's a longer list, of course, but if I had four, as I said, that I had to get out of the house before it went up in flames, those four are at the front door.
Nice.
They're not at the front door now, but they would be the front door if they needed to be.
Well, I'm glad you said One Up on Wall Street last, because as you were going through that list, I was feeling disappointed in myself. I hadn't read any of them. I'd read Joel Greenblatt's subsequent book, The Little Book That Beats the Market.
Not as good.
So I've got three more on my reading list, but yeah, One Up on Wall Street is a absolute cracker. So phew, we got 1 out of 4.
Yeah.
So I guess in a world of real-time data, of hot takes, of media constantly baying for your clicks and views, how do you create space for like deep reflective thinking, and what role does that play for you and I guess your team more generally that you try and instill in them?
Spot on, Alec, and that is what is missing probably in my world. And I would think if fund managers and investors are being truthful, they'd probably say the same thing. Well, what is missing is thinking time.
Yeah,
is time to step away and just think about what I've just read, what I've just observed. Is something happening here that I need to be reacting to, or is this just more of the same noise? And I'm going to sit with what I've got. I'm going to sit with my exposures and my positions, and I'm going to move forward. The absence of thinking time, to your comment, reflective thinking is mission critical, and we've all got to work harder at earning that and finding time for it, because you have to process, and there's a lot of information on a daily, hourly, almost minute by minute basis that's got to be processed. You actually need time to sit back and think about processing it, because the big money is made in investing. The big money is made in the sitting, not the thinking. Now I've just borrowed that from someone else's toolkit. But the big money is made in just sitting in positions. And if you become too reactive to daily news flow and people's opinions and broker research reports, and if you become you'll never actually hold a position down long enough to make any money out of it. So you need to be able to stand back and in fact know when to fade or ignore someone's recommendation. And there are some analysts out there, heaven forbid, when they put a sell on something, it's actually a tacit buy recommendation, and you need to know how to react to that too. So I think it really is being able to ignore the noise, think about things, and sit with what you've got. You need to do that, and that is honestly the secret on making money in the market. It's not day trading. A lot of fuss is made about day trading, and I think it's one of the most overrated pursuits in equity investing. It's actually the sitting back and putting positions down and monitoring them. That's where the real money's made.
It is such a balancing act, and I'm interested how you train the team around you, because on one hand we internalize this idea that you've got to be a constant learner, and you read that Warren Buffett reads 500 pages a day, and there's so much information out there, and investing is a game of having an information edge, and so like that next thing that I read could be the thing that unlocks all this insight. But then at the same time, there's like so much power in reflecting on what you have consumed and being bored and shutting the emails and just thinking. Like, how do you build the structure in your team's day to like find that balance and get it right?
Well, I think you're probably right. Warren Buffett might read 500 pages a day, but Warren Buffett doesn't trade every day. Warren Buffett probably
doesn't
trades.
even have a computer, does he?
Doesn't have a computer. I suspect that's right. So that I think that goes to the discipline around you don't have to be doing something all the time. You can just be sitting back and thinking. And I think that's what with our team. We have over the years slowed the tempo of what we're doing down. We're not feeling like we've got to react to every news item. We're not trying to get in ahead of the company's result and then get out 2 days later. That's a false economy pursuing that sort of work. So it's all about I know with our team, it's sitting down, it's doing the work, and don't rush it. Let's not rush it. Let's be satisfied that you've done the work. And if you're not totally sold on the story because of the works, then speak to someone, speak to an analyst, speak to a competitor, look to an international compco, and we're often now looking at companies, it might be a retailing company, go and look at an international US retailer and see how they've reacted to the same sort of situation. So it's really slowing the tempo, using the full extent of our resourcing, which is, as I said, international companies, information's available, pondering more fully your options and what you should be doing, and just taking your time. And that will invariably mean, as it has with us, a much lower portfolio turnover. We're turning less stocks over. We're just sitting there. We're putting slightly bigger positions in place because we've got the sufficient confidence that the story warrants a 3% bet, when before it might have been, we'll put 1% on and we'll think about that. You put a 3% position down, means you're a little bit more diligent about before you put it on, and you're certainly diligent about how you monitor the position. So it's really, with our team, it's been just settling it all down, do the work. No one needs to be doing something every day. The brokers might want us to be doing something every day, but as a money manager, we take our time. We'll trade when we need to. And there might be days when we've got 20 trades on. There'll be days when we don't do anything. And I think that really is how we've changed. And it's also the other critical thing, Alec, is when you're on a story that's not right, and stocks start to, some stories, there's always a problem child in the portfolio, and some stories companies will, their story will change. You need to learn the art, and we've learned it, to be a very slow buyer and a fast seller. And that picks up on when a story changes, the thesis changes. Hang on, that's not what I heard last time we spoke to them. They've changed. You need to know very quickly whether you need to be off this horse and onto something else. So the art of learning to be a considered buyer and a fast seller is what our team is all about, and we've worked very hard on getting that right. And I think that is something that we're still trying to get right, by the way. Being a good seller and a fast seller when things change. You'll hear any fund manager internationally who gives an interview who's truthful will talk about the difficulties of getting the selling piece right. That's the tough bit, getting the selling piece right. And we continue to work hard on getting, as a team, getting our selling discipline right.
Well, Ben, let's bring it all together, your years of experience, all the indicators and elements of the toolkit that we've spoken about, and talk about what you're seeing right here, right now in today's market. How would you describe the current conditions at the moment? Is there anything that's unfamiliar or unusual, or is it just sort of business as usual?
Yeah, well, I mean, we've all been observing the events of the Trump presidency and the volatility that goes with that. So I think conditions generally, there's turmoil as far as policy in the US, trade and tariff policies generated enormous turmoil and concern in stock markets and asset markets generally. And then there's the lure, of course, of tax reform coming and deregulation and so on. So there's a lot of that noise that's swirling around that needs to be considered, and what's the fallout for Australia, for instance. The geopolitical position has rarely been this volatile, between what's happening in Russia, Ukraine, what's happening in the Middle East. It's extraordinary. Those conditions are unsettling, but however, what is not unsettling is the behaviour of capital markets. Markets have looked through it and said, no, we're relaxed here. We think there's a solution. The conditions also, where I'm quite upbeat about things, is the fact that most major stock markets are at all-time highs. Quite extraordinary given the concerns and the volatility, and the old technical rule of always buy stocks and markets at new highs. If that's your guiding hand, which it is one of my rules, is there's something bullish about a market at an all-time high. Don't be afraid of it, embrace it. And we've got so many big and large cap indices globally that are at all-time highs. That's a bullish thing. I talked a bit about credit spreads and how they're so snug and neat in the US that even concerns at corporate level are they're quite mild. So there's not a lot of angst there. And the final thing is, and I'm talking generally, in the US, we've had some concerns that the US is moving into recession, and the market has assigned a different level of probability about recession. That's changing now, and the current belief and thinking and observation would suggest that the Americans are going through a weaker growth area, not a recession. So the recession story is pushed back up in favour of probably pockets of weaker growth. You add all those bits and pieces together, that's a pretty bullish cocktail for stocks. And you've got interest rates on the way down. We haven't had a cut from 100 basis points was taken out of the US Fed funds rate last year, and Powell has been a little bit more circumspect as to how quickly he takes rates out this year. I think we'll probably get one in fourth quarter, a rate cut. But basically, rates are going down globally. That's an elixir for stocks. So add the rest of the elements I've just talked to. I think the level of investor interest globally is strong and healthy. Sentiment, as I talked to before, is neutral. It's not bearish or bullish. It's actually neutral. So I think generally the conditions are very good for investing in risk assets at the moment. If I bring the focus in on the Australian situation, and we've talked a bit about the influence of international markets, but what's happening down here. I sat in on a fantastic call the other day with Rick Deverill, who's the chief economist at Macquarie Bank, and he puts out a publication a couple of times a year, and he calls it the Macquarie Mid-Year Outlook. And he summed up beautifully the prognosis for Australia. And he said basically that the Australian GDP is a little soggy at the moment. He said that the Reserve Bank has got inflation right on target, and there aren't a lot of central banks that have done that. So the RBA have landed on target. Federal government debt is low and very modest in a historical context. And there's ample room for fiscal and monetary policy implementation. So we can have tax cuts at the edges. We can get interest rate cuts. We didn't get one this week, but there's another couple of cuts coming at the right time. As Bullock said in her release, it wasn't about direction of interest rates, it was about timing. Yeah. So it's not like the RBA's no longer going to ease. Yeah. It's all about just how quickly they do it. So I add Rick's comments, and certainly and the other critical point is the electoral cycle. We've been through the federal election. That's behind us now. We've got a government that's got a strong mandate to get on with business and get cracking. That's incredibly bullish to have that uncertainty behind us. So we've got a very favourable backdrop as far as the US and international markets go. We've got interest rates moving the right way, and we've got a fiscal position among our, especially at federal level. The state and local governments are a different discussion, but at federal, we've got a very healthy fiscal balance. So I see that, and I think conditions are very, very fertile for risk assets moving forward. So
love it.
Yeah, love it. Yeah, well, a bullish cocktail for stocks.
Yes.
So then, if you drill down on the Aussie market, and I guess particularly your part of the Aussie market, the small and mids, are there any sectors that you're getting particularly excited about? Anything that you think might be misunderstood by the market at the moment?
Yeah, I mean, even though the Australian share market, as measured by the All Ordinaries, is almost at all-time highs, there's always an opportunity somewhere. You've got to go looking for it. And so, good point you raised that, Alec. I think the gold sector. Now, the gold sector's had a nice run over a year or two. It's also had since June a nice little correction. Stocks have corrected, some of them 25%, some of them a bit more than that. But I think on average, gold stocks have come back. I mentioned the gold sector as looking particularly interesting. It's a big part of the Small Ordinaries benchmark. For those that follow benchmarks, it's about 14% of our investable universe is a gold stock. So It's a very, very big representation of the benchmark, despite the run-up in the gold price, the physical gold price. Can you believe that gold stocks nowhere near discount the current gold price? They're still implying a gold price that's 30% ago, 20 to 30% ago. So if you think that gold miners are producing ounces and selling today, then gold stocks are incredibly mispriced right now versus where the spot price is. So gold stocks for us look interesting, and then compounded by the fact that they're off, as I said, up to 25 to 30% from their highs in June. So I think you've got a very interesting part of the market there for investors to look at, is the mispricing on gold stocks right now.
Are there any specific gold stocks that come to mind, asking for a friend?
Yes, yes. We like, let your friend know, Bryce, that we don't like the speculative names. We like gold stocks that are at the bigger end of the market cap horizon. We like producers, companies that produce from more than one asset and looks like long production lives. And one gold stock that we own that is a good size, it's about $4.5 billion in market cap, is Genesis. And Genesis is a gold producer. It's also had the requisite 23% fall from its June highs. But that is, if there's such a thing as a sleep at night gold stock that's well managed, with an interesting production profile and exploration upside, that's also implying a lower gold price than the current price, it probably would be Genesis. Let your friend know.
Nice. I'll let them know.
Genesis.
Yeah, good to know.
Genesis Minerals.
So that's a sector that you think is interesting, or that the setup is interesting there. And Bryce will chat to his friend and tell his friend to do his own research. But if we go on the flip side, are there any parts of the market where you think investors and advisors should be cautious? Maybe it's run pretty hard, or maybe people are getting pretty overly optimistic. Is there anything where you're just like, whoa, just slow down?
Yeah, well, just as I said, there's always an opportunity somewhere in the mix, and such as the gold sector. The flip side is also valid, where there's a sector or part of the market that is vulnerable for one reason or another. Look, I've had to think about that, and there's one little niche in the market that is vulnerable, I think. But the challenge is, has that vulnerability already been priced? And in that I'm referring to the travel sector. You know, you got your corporate travel, you got your Flight Centre and Hello Worlds and Webjets and the like. The travel sector, those stocks, with the exception of Webjet that's been under bid, those stocks have had earnings issues. There's earnings concerns, but they've actually rallied off their lows, where the market is thinking the worst has been seen, perhaps. So the dilemma for a fund manager is they're worried about the earnings outlook. And why are they? Well, because there's been several industry surveys, including one recently from IATA, the International Travel Group, that talks about hotel room rates and hotel occupancies being under pressure globally. They talk about air traffic also being under pressure and air tickets. So the airline industry is under all sorts of pressure at the moment, as is the hotel industry. Travel is not doing it easy. If you just throw in over the top the fact that consumer and business confidence has been ebbing somewhat and coming back, and then add in the spice of geopolitics and what's going on in the Middle East, people less willing to jump on a plane and travel to Europe when they've got to go through what was a war zone. There's enough going on, quite apart from the official data coming from IATA, that says travel's under pressure. People aren't travelling, despite the fact your friend Bryce, perhaps before he or she buys their gold stock, they might well have just got off a plane from somewhere. People aren't travelling. So there's pressure on travel data, and we think that has ramifications for listed travel names. It does. It's the extent to which the modest rebounds we've seen reflect the full extent of that angst. So we're a little bit concerned in the next 6 months or so about how travel stocks will fare. So not all smooth sailing. In a market that's at all-time highs, there's sectors that are cheap and attractive, and there's sectors like the travel stocks that might have some work to do with some heavy weather.
Nice. Well, Ben, that brings us to the end of our conversation today. I think we've been taking notes here for video and whatnot, and there's just been a bunch of actionable insights that I think we've taken away, and that so many of those listening today will as well. So we really appreciate the time. That was fantastic. Thank you.
Gents, as always, a pleasure to be on, and happy investing.
Yeah, thanks,
Thank
man.
you.